over the next hour, we will address the big picture of what's happening with the SBA and Congress in particular, how that affects franchise financing, the new regulatory and SOP, standard operating procedures changes, lender reaction to those changes, franchisor reaction to the SBA changes, and the Franchise Registry solutions. SBA is a very large lending source to the franchise community. So I think it's really helpful for everyone in franchising to understand the bigger picture of what's going on at SBA to put the recent franchise changes into perspective. So I'm going to call it the tale of two cities. It's the best of times and the worst of times. The reason why it's the worst of times is because the SBA has had an unprecedented inquiry into their portfolio. They've had 7 congressional committees asking about the portfolio in just a 6-month period of time. The House Government Oversight and Government Reform Committee, this is the same committee that investigated Mylan of EpiPen. It is chaired by Republican Jason Shevets from Utah. They subpoenaed an unprecedented amount of records to investigate the portfolio. More recently, the House Views and Estimate sent a letter last week, or I'm sorry, the beginning of March to SBA and provided a press release saying that the committee is going to provide aggressive oversight of the 7A program, and that the SBA must ensure that it can provide proper oversight to its capital access programs so that the underlying public policy goals are met. Now this is unprecedented, as I said a couple of times. So the question is, what's driving this? Why is Congress spending so much time looking at the SBA portfolio? So it's helpful to know that the 7A portfolio has grown from 2012 to 2016 at a 58% increase. So the total SBA portfolio is $78 billion. So this is a much greater risk to the taxpayers with a portfolio of $78 billion. In terms of size, this puts SBA's portfolio in the top 1% of bank sizes. There are only 35 banks that have over $50 billion in assets. So SBA would rank as the 31st largest bank by assets. So there are some other things that are playing into Congress's perception of risk in the portfolio. It's that market premiums are at all-time highs. The loans are being sold off on the secondary markets. That market is growing. So between those two things, there's concern that the incentive is very high to book bad loans. And the reason why they're concerned is because the U.S. taxpayer, well, you and I, are on the hook. So as an oversight committee, for them, this looks a lot like a pre-2008 run-up with unintended consequences of incentives driving bad loans. I would really encourage you, when you have free time, to listen to the Mylan Hearing Committee meeting because these are Republicans on the committee, as I mentioned, Jason Shevets, and also a few folks from the Freedom Caucus, who otherwise are really fine with a profit motive, and they don't actually believe in government intervention into private enterprise. But what they said on this video is that to Mylan, that you came to our offices asking for government assistance, so you asked us into your business, so you brought this inquiry onto yourselves. Now at the same time, the SBA's mantra is grow, grow, grow. So the SBA wants to continue to grow the portfolio even though Congress is concerned about the growth of the portfolio. And so to meet this objective, they're trying to make SBA lending so simple a caveman can do it. And this is have been happening over a period of time. So by statute, the SBA must only provide assistance to borrowers who are unable to obtain credit at reasonable terms elsewhere. Now back in the day, for those of you that remember, borrowers would actually have to get multiple turn-down letters from a bank in order to prove that they in fact needed an SBA loan. Well, in 2014, well, that was I don't know exactly the year when that was no longer in effect. But then in 2014, the SBA's desire for simplicity led them to eliminate the personal resources test. So this is a test for SBA loans where there was a formula requiring anybody with a 20% or greater ownership of the business that they had to use a portion of their personal resources to reduce the share of SBA's financing requests. So this formula required the owner to inject capital to the extent of their liquid assets in the excess of a specified multiple of the financing package. So this in turn would naturally attract borrowers that had more personal liquidity to the SBA programs. And one would think that they would be credit-worthy borrowers and increase the probability of success for business. So that's the positive side. But on the negative side, without those kind of governing elements of the personal resources test, there's been growing concern that the borrowers who can obtain credit on reasonable terms elsewhere are now receiving SBA loans instead. And that's another concern why they think demand for the SBA loan program has spiked. And this is one of the other reasons for the backlash, because optically this looks really irresponsible. Why would SBA eliminate a personal resources test for a loan program where you're only providing assistance to borrowers who are unable to obtain credit at reasonable terms elsewhere? Then also in 2015, SBA created a software system called SBA One. At first, they were going to require all lenders to use this exclusively because it would be a guided process where a lender couldn't make a mistake. So presumably anybody without previous experience could do an SBA loan. So that would attract more banks to the program, more SBA loans, grow, grow, grow. Well, that backfired to some extent because lenders have their own software systems that are far more sophisticated than the SBA systems. So now they're allowing lenders to stay with their own systems to process SBA loans. And then in 2016, SBA changed the franchise regulations to allow borrowers who own other ineligible business to get financing for an eligible entity. So the existence of that ineligible business didn't affect the loan for an eligible business. So that was widely applauded. But then the SBA went further with the SOP changes, the standard operating procedures. And so the changes met with large enough pushback from franchisors that a temporary measure was instated in February. So we'll go more into detail in just a moment on that. And whenever we're talking about SBA financing, it's really important to keep the broader financing picture in mind. So the franchise lending cycle, I equate it to similar to a tidal wave. So coming out of the recession, lenders were really slow to open up their credit box. For instance, nobody was lending to restaurants or hotels. And over the last 2 years, lenders have really loosened up their credit boxes to compete for deals and to expand their market share. So now you can actually get credit for any type of borrower. The terms will just be different for the credit risk associated with that borrower. But then after this kind of tidal wave comes a credit contraction. There are some small warning signals of a credit contraction. In small business lending, we saw the highest delinquency rate since November 2012. We have zero down financing. I've heard lenders talk about how the market feels like 2008 before the crash. That's how competitive it is. And lenders that have been traditionally heavily concentrated in one sector, such as the restaurant space, they're looking for other sectors to diversify their risk because they simply can't compete. And the other aspect is that we'll see rising interest rates this year. So what does this all mean? With the increased oversight by the House Committee on SBA, there's going to be increased oversight on lenders. So that means to you, franchisors, you need to get ahead of lenders and any negative effects on the SBA landscape to eliminate the hurdles that are unique to franchise financing in both the SBA world and to lenders overall. This morning I read a newsletter that's produced by an SBA outside counsel that said, remember, the lender has the burden of proof of compliance. So lenders need to always ask themselves if they have enough documentary evidence in their file to prove that they have complied with all applicable SBA requirements. The mantra of document, document, document is, cannot be emphasized enough, because what SBA lenders often find themselves are on the receiving end of a recommendation for a repair or denial. That means that SBA is not going to pay the full guarantee. That's a repair, or won't pay it at all, which is a denial. And it's not necessarily because they failed to comply with the loan requirements. It's because they failed to document their SBA compliance in their loan folder. So the deficiency is often one of omission rather than commission. So what you need to be prepared for is, if you're not going to get ahead of the lenders and help them, is that it may take longer for franchisees to access capital, because lenders will be more certain or take more time to document and be sure that they aren't missing anything, because they don't want to be caught with a repair or a denial. And it's important to be nurturing more relationships with lenders to ensure that your franchisees won't be challenged on the receiving end of trying to access capital. Now, over the past 3 months, we've held 4 webinars with lenders, and surprisingly, we've had over or close to 4,000 lender attendees. And we've been taking the pulse of how lenders feel about these new SOP changes. Overwhelmingly, 69% of lenders feel either uncertain or negative about the changes, and 78% are uncertain or negative about how these changes will affect the number of franchise loans that they will be able to make. Change really does always create some level of uncertainty, but I believe that this level of uncertainty is more than what SBA intended. In the view of some community banks and small lenders that we've talked to, they think that SBA is trying to discourage franchise lending, even though we know it's not SBA's intent to do that, but that's the way it feels based on the way the changes actually played out. And we'll understand in just a moment why that is the case. So the new SBA Franchise SOP. I'd like to first take a pulse of those of you on the webinar to find out, how do you feel about SBA's franchise changes? You can go ahead and vote, and we've got a large group here, so we'll wait till we get everybody's responses. I think it's fun to watch the responses come in slowly and see things change. Okay. We're starting to see that 14% feel positive, equal amount feel negative, and 72% are uncertain. And let me ask, have you had a chance to review the new standard operating procedure? We've been, I guess, about 3-4 months into it. So I think these results might look a little different than our earlier webinars. Interesting. These are actually matching up very similarly to other webinars, about close to 50-50. Slightly more have reviewed SBA's new standard procedures. Thank you, everyone, for voting. I appreciate it. Very similar results to other webinars we've had with franchisors, is that there's a lot of uncertainty, not really sure how to feel about the changes, and about half of you haven't actually had an opportunity to review them. So before we get into the specific changes, it's really always helpful to have some historical context. So many of you have been around in franchising for a long time and may remember when SBA franchise reviews happened prior to the financial crisis. So they used to only look at a handful of issues that were focused on what SBA calls franchise affiliation. And I'm going to make a distinction and maybe say it a few times. Franchise affiliation is different than eligibility. So we've been always talking about franchise eligibility. And now all of a sudden there's this new word called franchise affiliation. Franchise affiliation is really a subset of eligibility. Eligibility is a broader term for SBA lenders, and we'll see why that matters in a minute. But SBA only looked at franchise affiliation prior to the recession. So these are the issues that most of you are familiar with in the franchise agreement that SBA determined prevented a franchisee the right to profit or sustain a loss commensurate with their own efforts. So at the time, most of the addendums focused on the transfer issue almost exclusively. Well, then came the financial crisis when SBA experienced unprecedented losses in their portfolio. SBA reviewed all the defaulted loans and noticed that a significant number of issues that lenders missed in their loan evaluation. This is also the first time that SBA saw franchise affiliation issues by their interpretation could affect a franchisee's right to profit. So they started expanding their reviews. And this is when more rules came into the franchise affiliation review. That's when the addendum started going 1, 2 pages, 3 pages. And then SBA started reviewing other documents for other SBA requirements. And then they started consistently making determinations on business eligibility. So this is different. Business eligibility is different from franchise affiliation. The most famous of these is Sola Salons and Salons by JC. So these poor franchisors, they were taken off the Franchise Registry in August of 2009 because SBA determined that these businesses were passive and therefore not eligible for SBA financing. So it had nothing to do with franchising. The SBA then determined in October 2010 that they were eligible businesses. And then again in 2014 determined that they were ineligible businesses. This is also in 2010, SBA determined that master franchise agreements were ineligible because of business eligibility issues. So they also consider master franchise arrangements to be passive. Now area rep agreements, they do not consider to be passive. However, it is a disputed issue at SBA, and so we have had franchisors that come across franchise attorneys who have determined it's ineligible. So that is one that we address on the Franchise Registry and go to bat for franchisors because it is eligible. So, and then in 2011 is when they expanded their review to all other documents to meet all other SBA requirements. In many ways, the new SOP is going back to pre-recession days. So I think the easiest way to illustrate the differences between SBA's new standard operating procedure and the old operating procedure is to have a side-by-side comparison. So over the last 7 years, SBA has put out a new SOP nearly every single year. Since you, as franchisors, don't really live your lives in SBA's SOPs, it's helpful for you to know that the SOP 5010-5H was put into effect May 1st, 2015, and then the most current version was put into effect January 1st, 2017. Now, subsequent to January 1st, 2017, the SBA did put out another notice in February that revised the January 1st SOP. So let's review the differences. In 2016, SBA provided lenders with determinations on everything related to the hurdles that a franchise uniquely brought to the franchise equation. Now, the reason why I say the franchise uniquely brings to a financing equation is because if there are any issues, the only entity that can really make changes to satisfy SBA requirements are the franchisor. In any other type of small business loan, the small business entity can make those changes. But these are unique to franchises because the franchisor is the only one who can address any issues. So what they took care of was they provided determinations on a brand's business if a brand was actually a franchise according to SBA's broad, unique definition. So they had a two-part test. Is there a product or a service and a trademark? So the product or service was one part test and the trademark was the second. So it was much broader than the current standard. Determinations on business eligibility. So lenders and SBA can debate about salon suites brands, but at the end of the day, the SBA stood by their listing on the Franchise Registry and no lender suffered a loss because many lenders were making all these loans during the time where SBA took them on and off, decided they were and weren't eligible, because they absolutely vetted the business eligibility and subsequent leadership position changed their opinion. Customized franchise affiliation addendums by franchise system and a certification by franchise, and a negotiated streamlined solution for other documents that met SBA's requirements. So now in 2017, SBA has two options. They have, with the notice that came out in February, they are allowing franchisors to either sign the standard one-size-fits-all franchise affiliation addendum, and then thankfully the SBA listened to the franchise community and allowed franchisors to use their previously negotiated addendum, either 2015 or 2016, for any loan for any franchisee, regardless of which agreement they signed. So that means that as franchisors, you don't have to wait for SBA to provide a determination. What it does mean is that anybody who wants to have a custom addendum no longer can have that, that ability. And we're not entirely sure how long SBA is going to keep that temporary measure in place. So what you do have is a streamlined solution for franchise affiliation. So you can either use the standard affiliation addendum or your 2015 or 2016, and there is a certification document. Also a part of that, there is language in both the addendum and the certification that didn't exist before, referencing the False Claims Act, and some franchisors have expressed concerns about this, but SBA has not been willing to change their opinion on this, but it is something that we have shared with the IFA. So in the meantime, there have been three risks that have been shifted back to the lender. The first is that the SBA has changed their definition of a franchise, and the lender must determine whether the brand's business meets the FTC guidelines. So this means brands like FedEx, Allstate, Nationwide Insurance, Save-A-Lot, and many, many, many more, they were considered franchises by SBA. Now a lender has to determine if they are franchises. They had never heard of the FTC rule, most of them, before November 2016. So there are lots of loans that are stalling on these deals, and we're getting frantic calls by lenders and franchisors, or non-franchisors, because of this change. The second risk is that lenders must determine business eligibility. And this is an area where most franchises were held up for the longest period of time when SBA would refer the Franchise Registry applications to the Office of Litigation. whereby the business operations manuals were reviewed. Most of you probably don't know the difference between business eligibility and franchise eligibility. So business eligibility is an area for lender concern, just like franchise eligibility, because if the business isn't eligible, then it's not a government guaranteed loan. So in this SOP, SBA expanded their business eligibility rules so that any business that's targeting a subset of the population, it needs to be vetted for discrimination. So previously, it was explicit in the SOP that lenders should look for gender-specific gyms. Now it is much broader. And the SOP is clear that lenders must look through and read the entire FDD to also look for other SBA requirements. So real quick, on the business eligibility with the expansion of discrimination, there are a lot of more franchise businesses that are being caught up in this change. With regard to other SBA requirements, I recently attended a webinar for lenders given by a lender association. And a lender asked, can you provide me with a list of other requirements that I should be looking for in the FDD? And the presenter said, no, such a list does not exist. You have to be a prudent lender and do your due diligence. Now for a small lender, this of course seems like an overwhelming task. I need to read through an entire FDD to find out if there's any language in that FDD that conflicts with other SBA requirements. So in the meantime, we have been talking to franchisors to get your feedback on these changes. And the reaction has been positive and negative. So on the positive side, there is a reduction in the number of rules. So the new Addendum has fewer rules in it than what the SBA was vetting for before. And for franchisors who liked the Addendum, they were thrilled because they didn't have to wait for franchise affiliation reviews. With the change, much larger franchisors are happier. So what we found, and I'll give it some context, franchising falls into 230 subsectors. So every type of business model falls into franchising. And Chase Bank eloquently indicated to me an analogy that I think we're experiencing here in franchising, which is they're the largest bank in the world. So they have loan documents that they require and would not ever give up that a small bank wouldn't require. And it's because Chase has a lot more risk than a smaller bank has. And we've found the same to apply in franchising. The largest franchisors have had the most number of issues with the Addendum and the SOP changes. So the Addendum caused concerns for some kind of big picture concerns were not giving franchisors the ability to provide clarifying language or the flexibility to craft a solution that met their business needs. So for instance, a franchisor preferred their old Addendum because the new Addendum lost some language that was helpful in the event of a termination. There was more clarity in their Addendum. The Addendum also takes away the franchisor's right to step into a business. And the previous Addendum was a little bit more flexible in terms of step-in rights. And for one, even though the SBA rules have prevented franchise systems from being eligible for SBA financing if they hire and fire employees, there has never been a customized addendum observed that include language stating that the franchisor doesn't have the right, doesn't control their franchisees' employees. So many franchisors have expressed outrage that the addendum has an embedded presumptive length of joint employment. One franchisor said to me, the franchise agreement explicitly states the franchisee is an independent contractor, and that should be sufficient. we've had franchisors explain that they don't actually care about the addendum. What they care about is that they have spent a lot of money creating solutions that will streamline the issues that arise in their other documents. So now, without a streamlined solution, will they have to negotiate with each and every single lender? There's also language in the SBA addendums that was designed to address lending and security concerns of the bank, including language to protect the bank's collateral and its priority interest. So I'm sure, as one franchisor said, banks will likely want to include some of these provisions in a separate agreement. And the franchisor indicated that they would allow, that separate agreement may allow them to incorporate some explanatory language that they need. So for those of you that have reviewed the addendum, what was your reaction to the one-size-fits-all addendum? Okay, results are coming in. And it looks like 40% aren't sure, 30% have concerns, and 23% don't have concerns. Thank you everyone for voting. And the other question that I'd like to ask of you is, do you know if other SBA requirements could affect your franchise systems? We do have some attorneys that are on the webinar, so you can respond on behalf of your client systems. Okay. We have some franchisors that know that they have other issues, but the vast majority aren't sure, are uncertain. Great, this is incredibly helpful feedback. And what you'll see is very similar results for other webinars that we've had with franchisors. Most franchisors are uncertain about other SBA requirements, and 40, it's almost exact, this is kind of scary, that don't know, and those that have concerns versus those that don't have concerns. So pretty representative. So one frequently asked question that franchisors ask is, well, is the franchise registry necessary, or what is the franchise registry's role going forward? Well, as a franchise system, as we discussed earlier, you always have hurdles that you're bringing to the lending process that are unique to franchising and can only be addressed by you. And it provides, if you don't address those, then you're providing uncertainty and risk to lenders. So the franchise registry has always solved these hurdles with you and erased uncertainty and risk for lenders in a streamlined and very cost-effective way. And so it will always continue to do so. So lenders rely very heavily on the information on the franchise registry. Just to give you some perspective, last month there were 3,500 logins by lenders. In total, there are 8,000 lenders on the site, and an average of 15 new lender members that we add to the site every single week for the past 2 years. And we've had lenders concerned that the information that they rely on will go away. And we had people, before we started conducting the lender webinars, had started downloading documents off the franchise registry. So we had to call them and say, don't worry, it'll all be there. And we're very assuring. So it is very confusing the way the SOP is written. The franchise registry has never been owned by the SBA. The SBA has never paid any money for it. It is a private site owned by Fran Data. And they did make their determinations available to the Franchise Registry. And that history of those determinations is what's incredibly valuable to lenders, both on a historic and a go-forward basis. So let's talk about how the Franchise Registry is kind of peeling apart these changes and helping you and lenders ensure that the lending process for your franchisees won't slow down. So the best way for me to show you how the franchise removes the unique hurdles in the franchise relationship is to see the lender's view of the Franchise Registry. So if we start with the main account page, every franchisor has a main account page which provides the business description of the franchise, the funds number, which is a unique number associated with your franchise brand, the NAICS code or codes that your brand exists in, franchising status, and the contact information provided by you, which tells lenders who they should contact for each purpose. So the contact information is incredibly useful and critical to ensure the ease of communications, and will be used for e-signature delivery capabilities over the next few months. So every franchisor has a total of 5 folders of information to help lenders through the lending process, but we're going to really focus on the SBA folder. So this is what an account looks like right now when it is not up to date. So it basically is not addressing all of the lender concerns, and it shows up as unverified. When an account is filled out, as the sample on the slide, it goes through each of the hurdles that an SBA lender has to address. So the first of which is, who is the authorized person at the franchisor organization who can sign the documents for SBA financing? The second uncertainty that they have to address is the business a franchise according to the FTC definition? So as I mentioned before it was a much broader 2-part test. And so lenders really don't understand the nuance of this. For some of this is easy in franchising, but for lenders this is not easy, and loans are halting because of it. The second uncertainty that lenders need to address, or you need to address for lenders, is will you agree to sign either the standard addendum or the 2015 or 2016 addendum? And then we upload the addendum and the certification that the lender would send to you, the franchisor, based on your response. In addition, lenders want to understand when in the process they should send you this information. So most lenders are going to send you it as soon as they can, because if you won't sign the document, then they can't move forward with it as an SBA loan. They may consider it on a conventional basis. That's possible, but they wouldn't be able to consider it for an SBA loan. So for those of you that have certain requirements of when things need to be signed, if the documents are put into escrow, or any of the process issues that are important to your franchise system, that's what is outlined in the notes section. So the particulars of when you will sign the documents. The next issue is business eligibility. So as we talked about before, SBA has made decisions on brands regarding business eligibility. And this is a considerable risk to lenders, as loans without an affidavit for Curves for Women franchises, they were denied their guarantee. So what this means is that loans that lenders made with the assumption that their 75 to 80% guarantee was not actually there. If additional documentation is required to meet that business eligibility guidelines, then the additional documents would be underneath that section. So for instance, the brands that market their business to one segment of the population, they have to have an affidavit signed by the franchisor and then also signed by the franchisee. And finally, there are risks relative to other SBA requirements. So there are brands that have comfort letters, subordination agreements, lease agreements, and the like that have been deemed to not be SBA eligible or not meet SBA requirements. Many of these other requirements are focused on credit issues that, for instance, impair the ability of the lender to foreclose. There's one franchise that whose lease agreements do not meet other SBA requirements, and that franchisor is unwilling to modify their lease agreements for the purchase of real estate unless the franchisee has 5 or more locations. So in instances like this, we're just communicating what the issues are to lenders so that they don't make a misstep. Because if they make a misstep, then ultimately it comes back to harm you in terms of access to capital. So for all of you with Franchise Registry memberships, any of your other documents that have issues that were fixed in your previous SBA addendum will now be addressed in a separate document and posted in the other SBA requirements section. And we'll explain to lenders what was modified to meet other SBA requirements. And all of the other documents will refer back to decisions that were made by SBA so that lenders have the documentation and the assurance that their guarantee is secure. And if there's one thing that I've learned over the course of the last 18 years involved with SBA lending, it's that the number one concern that lenders have is that SBA guarantee. They would not be making the loan without it, and they want to be 100% guaranteed that it's not going to be impaired. So SBA consistently advises lenders that the paper trail is the one way to assure their guarantee. And so we're helping lenders with their paper trail. A lender also has the ability to follow your brand and make sure that they're updated with any new information that has been put into their brand. So they will have a borrower, let's say they have a prospective borrower that's associated with brand. Many lenders will log into the Franchise Registry with their username and password. They'll search for your brand name and go into the SBA loan folder. The second way is that they'll put your brand into their portfolio. So many lenders have an established list of brands that they work with and who they lend to regularly or who they want to lend to. We have a few lenders that have 1,000 brands in their portfolio, but the average lender has 50 brands. And so for every brand that's in their portfolio, the lender is alerted whenever there's a change on the franchisor's account. So any change, whether that's a name change, a brand change, change in number of units, a new franchise disclosure document, SBA documentation, if you have a bank credit report, and a fund score if there's a new fund score that's available. So this includes any piece of information on the SBA tab, including whether you'll sign the affiliation addendum, when in the process you'll sign it, if the business model meets the definition of a franchise according to the FTC, if the business model is eligible, and if there are other documents to resolve the other SBA requirements. In addition, lenders can customize the notifications based on brands within the portfolio and for the site overall. So lenders can be notified. Well, the default is for lenders to be notified of any new franchise that has been added to the site for the first time. And they would also be notified for any new franchise that says they are, whose SBA account on the Franchise Registry has been updated. So this is really important to lenders both when they have a deal, if the account is being updated, and for business development purposes. And to give you a sense of scale, the Franchise Registry does add about 1 to 2 new franchise brands a day with a new funds number. Lenders can also find out about you through an advanced search. So lenders like to do business development on the Franchise Registry to find brands that meet their criteria. And so they can put in the minimum number of franchise units or number of years franchising, and they would also put in, because if they're an SBA lender, whether or not you are SBA compliant and have a verified account. We ask lenders, given the new requirement, where they're most concerned about their guarantee. And so we ask them, is it incorrectly identifying that a company meets the definition of a franchise? Is it, will the franchisor require additional documentation to clarify the SBA Addendum? Is it not satisfying the need to review other documents correctly to resolve any issues related to other SBA requirements? Other, all of the above, or none of the above. So the vast majority, over 50%, said all of the above is where they were concerned about their guarantee, and only 4% said none of the above. So what should you take away from all of this? I think it's first important to understand that lenders come in all shapes and sizes. And so it's interesting when you're a part of the SBA world and you learn more about the different types of lenders. So you have some lenders that are nationwide lenders that have an assembly line production shop. So your documents are going from one part of the assembly line to another person to another person. And so they have specialists who are specializing in SBA eligibility or who specialize in franchise affiliation. So then you have a lot of specialists. Now there aren't that many lenders that are assembly line production shops. You have lots of lenders who are regionally based, and they may have business development officers that are doing some of the credit write-up. You might have someone who has a credit team that they deal with, depending upon their size. And then you have SBA lenders that are small and may do 5 to 10 franchise loans a year. And there are a lot of those guys, and they might actually outsource their SBA processing to a lender service provider. And so you have a lot of different levels of sophistication in terms of volume of both SBA and franchise lending. So this is going to impact not only the experience, some of which can be very positive, but also they're going to have different levels of friction depending upon the type of bank. So what you can do today to avoid any kind of slowdown in franchise financing, regardless of the type of lender that you're dealing with, is to make sure that your account on the Franchise Registry is up to date. So what you want to do is let those 8,000 lender members know whether you'll sign the addendum, which addendum you'll sign, under what conditions, that your business is eligible, or if not, how it's solved for, and that make sure that all the other SBA requirements are addressed. And also to make sure that the contact information is updated to really streamline the questions and the documents that need to be signed. You can also increase your appeal to lenders by understanding the credit risk perception of your brand. And your Franchise Registry membership does include access to your franchise credit report and credit score. And you can also improve your lender perception by including any other supporting documents to enhance the lender's understanding of your brand and the business model. So this is what we call other documents. Your Franchise Registry account manager would have to upload all of these documents for you. And we have some exciting things coming soon that will help you to not only understand lenders' process, but then also to be able to search and find lenders that are in areas where you're looking to grow or have a certain type of credit box that it matches up with your brand profile. The first is which we're going to give you more access to be able to see lenders that have interest in your brand. So right now you can see some lender activity, but we're going to give you some more enhanced ability to see the lender's profile and what they're doing with your information, to be able to contact them and understand their process and see if you want to get involved in terms of what else you can do to help. In addition, we're going to give you, I feel like it's kind of unfair because lenders can search for you, but you can't search for them. And it only makes sense that they already have a profile that's filled out so that you can search for lenders based on the type of lender that they are. So we do have both SBA, conventional, and alternative lenders on the site. So you'll be able to figure out, so this is the profile for a search for an SBA lender, looking for the geographic preference, the lender's industry preference, and the types of loans that they like to do. Some lenders are very strict about the types of loans and the types of borrowers. So you don't want a franchisee going to a bank where there's no chance of success with that lender. Okay, so now that we've gone through the SBA's SOP franchise changes, how do you feel now about those changes? Okay, results are coming in. And it looks like some people are feeling a little bit more positive now that they understand the changes, but there's still a high level of uncertainty and some of you that are not feeling very happy about the changes. So we have a few minutes for questions, and I'd love to open up the chat to any questions. Doesn't look like we have a lot of questions coming in. Okay. Well, if we don't have any questions, or if you have any that come to you after after we get off the webinar, we'll be happy to answer them. So where can we find the new SOP form? Yes, well, one question did come in. The SOP form, we can, if you send us an email at franchiseregistry@frandata.com, we'd be happy to send you the new form. Another question came in, why do I still need the franchise registry? Yes, so that's a good question. I think it's quite obvious why you need the franchise registry, because lenders have a lot of hurdles and uncertainties, and the easier you make it for lenders, then the easier it will be for your franchisees to access the best and most number of capital sources. With that said, thank you everybody for attending, and for those of you who have not connected with your account manager at the Franchise Registry, I know they're reaching out, but you can also email them to set up time to update your account and to renew your membership. Thanks everybody, and have a great day.